Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Zach Unger, analyst with our portfolio management team, who over the past couple of years has continued to make great strides and has become a wonderful contributor to our asset allocation team. So happy to have him on this team, and so happy to have him here this week to share some insight for you. This week we're going to keep it short and sweet. Now, admittedly, in most weeks, Andrew and I we tend to go a little bit longer than we intend. That's just, I guess, the nature of the stuff that we discuss. So we're going to do our best to keep it a little bit within time limits today, or at least a little bit more bite size, which is the original promise of the market cover. So today we're going to talk about interest rates. By the time you guys watch this, you're going to know more than we know right now in terms of what the Federal Reserve did in terms of interest rates. But we really have some interesting setup and market thoughts going into it. And then we're going to look at international markets and some great developments inside those markets. So first, we're going to talk about interest rate. And before we look up at the graphic of interest rate probabilities, I want to walk through an exercise and just share you a little bit of what we walked through in our investment meeting on Monday. So I ask you to just think about this real simply for a second. Now, this is not really how we think about investment decisions. We're usually not looking at finite periods of time, but I want you to imagine that you have an exact 2-year window. And the only thing that you're allowed to invest in are U.S. Treasury bonds. Now, essentially, you have two choices. Of course, you have more than that, but we're going to limit it to two to really highlight where the market stands here. So in one case, for your 2-year time horizon, you could purchase a U.S. Treasury note that will mature. You'll get your principal back in 2 years plus interest. If you do that, you will get a yield of 4.1%. Now, that was as of Monday as we were preparing for our investment meeting. So, update that for a couple of weeks. It might be quite a bit different than that, but you'll get the point. 4.1% would be your yield on that U.S. Treasury note. Your other option is to purchase a 1-year Treasury note and then 1 year from now buy another 1-year note, so that in 2 years' time you will have your principal back, but you will essentially have the interest on the first note plus the interest on the second note. Now, what's interesting here is, so 4.1% is that rate on the 2-year note. It is all the way up to 4.8. So 4.1 for 2 years or 4.8% for a 1-year note. What that tells you is the market believes that 1 year from now, your yield will be dramatically lower than 4.1%, because those two ultimately, in terms of how the market believes, those two should be equal investments. So they think that the yield would have to drop substantially for those two to be the same. Now, what I would tell you is that is the most liquid market in the entire world. So to think that we have an advantage or to really guess where the market, which one of those two is going to win is a very difficult task. The balance of our investment team was pretty clear. I mean, give us the 1-year note. We say that because the market has really gotten offside. So many people believe that the Fed is going to cut and cut dramatically. There are still risks that they don't actually or don't have the ability to cut as much as they'd like. And Zach's really got some more insight to share with you in terms of what the setup for the Fed is going to look like for the rest of the year. So, Zach?
Another way to look at how the market is pricing in expectations for rate probabilities is to look at the futures market, which is something that I have started to do pretty recently and have really enjoyed. It's given a lot of clarity to me. So as Adam said, by the time you guys are hearing this, you'll have some more clarity on what the Fed decided to do with this meeting. Last I checked, the probabilities based on the futures market, there was a 95% plus chance that we were going to get 25 basis points added this round. And so this particular chart here is for the December meeting at the end of the year. It's the last Fed meeting of the year. And each of these bars is a percentage chance based on the futures market that we will end up, the Fed funds rate will end up in these particular ranges. And so assuming we do get the 25 basis point hike this round, we will be in the 500 to 525 basis point range, which is your second bar from the right there. And so you can see the futures market for the end of the year. First thing I would note is that it's very, very widespread. So there is some uncertainty as to how things will progress over the course of the year. But you can see that the vast majority of the percentage points are at or below, mostly below the 500 to 525 point range. So what that tells us is that futures markets, by and large, are predicting that we will see uh, hold. The most conservative estimate would be a somewhat of a hold, and more aggressively, maybe a cut or several cuts going throughout the end of the year. Um, our job is to be intentional about um, counteracting maybe some of the market being eager to anticipate certain things, and there'll be a lot more data that needs to come out from the Fed, a lot more data that we'll see before they make those decisions, but will no doubt have an impact on how we manage portfolios moving forward.
Yeah, great summary. And to bring it home in terms of how we invest, it isn't always about trying to predict or second guess where the market's going to be on this, but we're very interested in terms of where the biggest pain could be if the consensus is wrong. And we really want to protect portfolios. That's our defensive mindset. And for us right now, the biggest risk or the biggest damage could come if that optimism for rate cuts isn't able to come through. That could mean a lot of pain for short-term bonds. It could mean could be damage for certain risk assets. So that's where we have a lot of our attention, and we'll be focused on how they progress from here. So the second topic for you today is on international markets. And in fact, really some great news as one version of international markets has reached an all-time high. And to really break down why this is significant, you have different choices for how you invest internationally. When you buy a foreign market, whether it's the Japanese or anywhere in Europe, you have the option of taking the currency risk. So taking your dollars and turning them into euros and buying those indices, or buying yen and then buying those indices. Then when it's time to bring that money back home, you've got to convert it back into dollars. So you're taking two risks. You're taking the foreign market and you're taking the currency risks. Investors also have the choice to hedge. And by the way, of course, it is much easier in today's world. We don't have to actually do these things. We could buy funds that do it for us. We can buy funds that buy directly into foreign markets and take that currency risk, or we can buy instruments that take out that foreign currency risk and just focus on what an impact would be if it was a dollar investor all the way through. Now, the value in looking at it in terms of taking out the currency risk is you can look at the true supply and demand and look at the true trends of the market and not have the currency, the strength in the yen or the weakness in the yen really mask the Japanese market or any other international market for that reason. So if you just look at a completely foreign hedged EFA index, it is reaching all-time highs. That is the blue line on here. And just for some clarity's sake, this is something I have to remind myself, even over 20 years in the business. One of these simple tenets I just have to have drilled into my head is that all-time highs are a fresh and healthy thing for investing. It can be counterintuitive. We're trained very early to buy low, sell high. So when we're reaching highs, that kind of dings that common sense and has us on alert. But it is a very healthy thing. It means that no investors in that market are seeing losses. And that can mean that there's buyers outpacing sellers. Demand is strong. And so that doesn't mean that next week or next month is sort of be clear sailing for international markets, but the trends are favorable. And they haven't been that way for a very long time. In fact, go all the way back to the end of the great financial crisis of 2008. It has been strongly dominated by U.S. stocks. So it is a breath of fresh air to have maybe some new leadership. And we certainly have been adjusting our portfolios and have been increasing our weightings all throughout the year to international holdings. And I will leave you with this as well. One thing that we have to be careful of within our portfolios are the individual stocks that we own. A lot of U.S. companies have significant exposure for their revenues overseas. We drilled into our portfolios and we find that roughly a 40% mix of the companies that we own, almost 40% of the revenues of those companies have the revenues overseas. So we have to keep that in mind when we balance out the risks in your portfolio as well. So, hey, we thank you for your time and joining us this week for the Market Carver. I hope everyone enjoyed it. We do appreciate it. Don't forget, as always, you can give us a call, 800-928-4001. And we hope everyone has a great weekend.